Hi, Christian. How are you? It's so nice to see you.
I'm doing super. How are you, Bogumil? All
I'm
well?
doing very well. I got to see you in person and spend, I think, 2 solid hours with you in Omaha not long ago, and we got to chat about pretty much everything. So I've been looking forward to this episode. For the benefit of the audience, Christian was on the show not long ago, so please look up that episode. And we had a really incredible conversation about managing money from a family perspective, long-term patient kind of investing. And you had a lot of questions for me, and we didn't have time in that episode. So I said, well, let's sit down and record another one where I'm going to do the talking and you're going to do the questioning part and see where it takes us. So the floor is yours.
Thank you. No, thank you for inviting me on to ask all these questions, Bogumil. And as you said, it was great to meet in Omaha. I think we met on the Thursday, didn't we, at
We
Upstream
did.
for pretzels and beer, which I greatly enjoyed. Um, and actually, Omaha is where I wanted to start the conversation. It's perhaps somewhat predictable, but I thought, especially coming back from Omaha this year,
Mm-hmm.
and it really felt like a tribute to, as it should, to Charlie this year. And I think it was an unusually sort of emotional meeting for many of us. And so it's always interesting to hear what people's impressions of the meeting were, but I thought especially this year because both of us have been a number of times. And so I'm curious to hear, how did you find the meeting this year, and especially what are the lessons you've learned over the years from Charlie? If we could, there are so, of course, there are endless numbers of lessons, but if you could sort of point to one or two things that keep coming back to you as an investor or as a human being.
Well, the immediate thought is to keep learning from Charlie. I feel like he gives us the blessing and permission to keep on learning. We go to schools, we get degrees. A lot of us think that we're done, but I think the real learning starts that day when you leave school. There's so much to learn. So many things that I've learned in the last 20 years managing money for families and things that you can't really learn at school. Anytime you find me, people ask, when does work end? When does work begin? You always find me with a book or with an annual report, and I'm always reading and I'm always expanding my understanding of the world. New company goes public and I look up their filings. I want to know what is it that they do. I might never own it, but I'm just curious. So I think the big blessing to keep on learning, that's been the biggest takeaway from Charlie. This year's event was different, but I want to say what was alike, like any other event, and it's the fact that it's this wonderful opportunity for so many people to get together. When people think about Omaha, they think about the main event that's televised these days, and you can watch it online. But it's really a fraction of the experience for me. Like you and I met, 2, 3 days before the main event, and we got to chat and spend time together. And people from all over fly in. I got to see friends who are based in Asia and in Dubai and in Europe and South America and all in one place for that one week. And it's such a peculiar experience. I told my wife when I came back that I don't think there's any other place and any other time when I know more people per square mile than I happen to know in Omaha.
Agreed. Yeah.
For obvious reasons that we think alike, but we do different things, and we have some shared principles that bring us together. I think for me, the whole event each year, it's kind of a reminder of principles that I want to hold dearly. And it's not that I will hear something I've never heard before, but I think you and I would agree that it's very useful to hear some things again and again and
Yeah.
again and again. And Charlie and Warren have really showed us how to not just invest, but run a business and have a bigger, broader life philosophy. How do you treat other people and all the other things that come with it? And I think they showed us that slow and steady can still win the race. You don't have to cut corners and make a lot of enemies on the way. You can actually make a lot of friends and build this wonderful network that can help you. And a lot of opportunities that came to them, they came through the network of people that they developed, nurtured over those many, many decades. But the 2 years were different. I think last year was the first true year when we forgot about the pandemic. We could freely travel, and it was just a very, very cheerful event. I don't know. It was just, I was smiling all the time.
Yeah.
And I think it was the two of them, and they had more energy, and they had a lot of optimism, enthusiasm, despite their age. And this year, obviously, one of them was clearly missing, and the whole tone and even the lack of music at the beginning ages of the event, there was this underlying feeling that a big part of the experience is gone. But I certainly hope that we can keep going to Omaha, meeting and cultivating this very unique experience for so many of us to come, talk, share, and connect over those 3-4 days in the middle of the US, where for those few days this place becomes a completely different place. And then when I said when the midnight strikes, the city comes back to what it was before. It's quiet and everybody flies out, and you run into people at the airport, and it goes back to normal. But for those few days, I think it's a pretty magical place. I don't know how you feel about it.
No, I agree. I have a similar experience of it in terms of. In fact, I find the challenge is you know so many people by now, and there are so many events to go to that it's almost overwhelming.
You have to
and
choose
then we'll have
pick.
to see. Exactly. Then we'll have to see if there's other events that will. I'm sure nothing can fully sort of replace or replicate the Berkshire meeting, but we talked about the Markel meeting, and I think there's clearly some attempt there on to build something, if not similar, but with the same sort of principles. And there's one or two other meetings that people tend to go to. So as we talk about Charlie's passing, I wanted to sort of make a comparison. Comparison might be the wrong word, but so Jim Simmons passed away last week of Renaissance, and I thought it was interesting in the way that certainly people in the investment community reacted to or didn't react to those news. If you compare that to the sort of reaction that Charlie's passing received, what do you think? I mean, obviously Charlie was a much more public person than Jim Simmons, but in terms of investment performance, I think Renaissance is, it's almost unparalleled. I think if you look at the time frame and the size of the vehicle and everything, so it almost seems to me that people gave Charlie the recognition and love, partly because he's an incredible investor, but largely for other reasons, right? And that includes people in the investment community. And, somehow with someone like Jim Simmons, although I think he was much admired, including by Warren and Charlie, by the way, I think they said a number of times that he's a very high caliber person, but it's a very different kind of reaction. So do you have any thoughts on that, Bogumil? Why that is? I mean, yeah, I was going to speculate, but I'll let you answer the question.
Let's speculate together. I have a lot of respect for both of them. I think they both accomplished, they had incredible records for various reasons. It made me think in that moment when you were asking that question I was thinking of an interview that Buffett gave with Bill Gates, and I don't remember how long ago that was. And it was a room, I think, of students, and they were all asking questions, and they seemed to have more questions for Warren than for Bill Gates. And Warren asked them, why is that? And he kind of hinted the answer, and he said, you can see how you could replicate what I did. And I'm paraphrasing, that's my memory recollection of that interview. And he says it would be very hard to replicate what Bill Gates did.
Yeah.
And it really hit me because we look at people that accomplish monetary, financial success out there. And one of the thoughts I have is there a way to reverse engineer what they did? And Bill Gates and his company, still a huge, huge entity, I think one of the largest companies, right? But it would be almost impossible to imagine to replicate it because there was a point in time, computers ending up on more desks at more homes and more offices. Software was needed. There wasn't one that worked, and on and on and on. A lot of things lined up, and obviously incredible execution with a lot of ups and downs on the way. But anyways, it would be very hard to replicate and say, let's sit down and invent another Microsoft. But what Warren and Charlie did, looking for eventually, quality businesses, that's not how Warren started, we both know, but eventually switching to quality businesses that we can identify. And Peter Lynch told us that we might actually know quite a bit about those businesses. And then holding them for the long run. I mean, I can explain what they did in under half a minute, right? And then we can dive deeper what it means. It sounds simple, but I'm not saying it's easy, but I can explain. And I think with Jim Simmons, as much as I admire what he did, he used algorithms to figure out some mispricings in the market and went after them and took advantage of them. I, first of all, don't even know how that worked. Second of all, I have no idea how to replicate it. Yeah. And third, you and I spoke about it. I think in the investment world, one secret is to find what to buy. But I think the bigger secret is having the ability, the confidence, the conviction, sometimes a true stamina, almost like emotional, psychological stamina, to hold on to it. And I shared with you when we spoke the other day how as long as I understand what I own, the actual business, the underlying business, it gives me a lot of comfort, even if the market disagrees with me, or even if we have a massive sell-off in the sector or the whole market. At the end of the day, I know what I own. I own a certain business with certain profits, maybe with some dividends, with brand, loyal customer base, and on and on and on. To me, it feels very tangible. What is it that I own? Now, investing the way Simmons did, as much as I respect that, and maybe there's room for this kind of investing, as we spoke, part of some allocation. If you told me put my entire family money in what feels like a black box where I don't know what's really happening, and the truth is they can't really share what's happening because they find those mispricings because people don't see those mispricings, it's a very tricky proposition. And I think that what you pointed out, that Charlie became such a public person. I don't think he always wanted to be. He ever wanted to be a very public person. And I think in the last interviews, so when he passed away, I actually spent that week looking up his recent interviews, and he actually gave quite a few. And in one of them, he said he doesn't want to be more of a guru to the young that he already is.
Yeah, I saw
right?
That.
And I think it was very powerful that he, on one hand, he embraced the fact that people wanted to emulate him. On the other hand, he still felt uncomfortable that people, glorify his success. One little thing I would add, which he brought up a couple of times, that he thought of Ben Graham, who was the mentor to Warren Buffett. How Ben Graham was a teacher as much as he was an investor, but he taught investing at Columbia for many years. And I think Charlie expressed this idea that he felt that he has to teach as well. He figured some things out, and that's half of it. The second half of it, if you did figure it out, why not share it with the world? And I think there's a beautiful lesson there. A very big encouragement for writing or even sharing content or having conversations like this. Like you and I could have this conversation completely off the record. But I think the fact that there are other people that can benefit from what we observed, noticed, learned, I think there's beauty in it. And the fun interactions that happen when people hear you and then reach out and share their perspective and their stories. I think we learn as much as they learn listening to us. I learn because they show me things that maybe I'm missing.
I agree. But it strikes me that even professional investors seem to, where I think you would normally expect that these are people who would only, pay attention to the level and sort of duration of returns that someone generates, still held someone like Charlie in such high regard. Now, of course, most people held someone like Jim Simmons in very high regard as well, but it seems clear to me that it's not just about, even for professionals, it's the respect you award to someone or admiration it's not purely or even mainly related to the sort of level of returns or the amount of wealth you generate. And I just think it says something about the maybe not the investor community generally or investors generally, but certainly the kind of people you see going to Omaha that, of course they're incredible investors. Charlie was an incredible investor, but there's so much more to it, because otherwise, people would be going to all these other gatherings, although I guess there's not the same opportunity elsewhere. But
when you share that, I'm thinking how I got into investing because I felt that it was an intellectual pursuit. I picked up One Up on Wall Street by Peter Lynch when I was a student in Brussels before I came to New York. And I saw this as a puzzle that I can solve. And I like that the market doesn't care where I'm from, if I'm young, if I'm old, and anything like that. That I can sit down and figure it out. And then the market will tell me if I'm wrong or if I'm right, especially if I have time to wait. And then once I joined the profession and I got to work with clients and managing portfolios, I started to ask the bigger question, whose money am I managing? What does this money mean to them? And I realized that it adds a whole layer and color and flavor and sense of fulfillment when you realize that you're making a difference in people's lives, but you also have a huge responsibility. And then different questions and different answers pop up other than statistically just saying these are the highest returns with this kind of risk and this kind of volatility. That's very true when you're an academic sitting in a room and writing a paper. But when you sit down with real people and you know that this is all the money they will ever have, I say that it's the money that they don't immediately need, so it's investable, but it's the money they can't afford to lose. It's such a powerful framework for me to think about that kind of money. So yes, I can show them all kinds of statistics, but at the end of the day, I know what kind of an emotional charge there is behind this capital, what kind of importance that capital has to them. And so many conversations start off with the fact that they cannot afford to lose it. They're not in a position to make it back. It might be a multi-generational fortune, or it might be a fortune created by them, and they came to a realization that they are not in a position to make it back if they lose it. Now, a lot of investment ideas are out the window, and a lot of risks are out the window. I like to say that there are certain risks that even the richest people cannot afford. And I think it's a big revelation. So I think there's probably a million ways to make money, and not just in the stock market, probably, if you think of all the assets. But you have to find a way that resonates with you as an investor. And in an ideal world, it perfectly aligns with the kind of clients you work with. And they give you the permission, the trust to do what you do best. And if you find that perfect alignment, I think it's a very happy place for you as a money manager and for your clients, that they exactly know what you're going to do and why, and you feel like you're doing the right thing for them. So I think there are all kinds of strategies and way to go about it. What resonates with me is seeing stocks as ownership of businesses, leaning towards quality, leaning towards open-ended, long-term, I say even an infinite investment horizon, where I can wait. And if you can wait, you realize that there's a lot less competition in that part of the universe. There are too many people trying to chase very short-term mispricings. I mean, even Simmons, the mispricings he was finding, they were very, very short-lived. Yeah. Just in the setting that he operated in, he was able to take advantage of it.
I am actually reassured by the fact that it seems like there's a very large group of investors that aren't purely looking to sort of optimize returns, whatever that means. That, generating good returns is clearly one important element of any, investment strategy or sort of investment setup. But there's more to it than that for many of us, which I find very encouraging. Look, so speaking about Omaha, Bogumil, I wanted to ask you more generally about, how to spend time. So I was in Omaha just like yourself, and then yesterday I went to something called the London Value Investor Conference, which was very good. And then early June I'll be going to Zurich just like yourself, right? And so now it's unusual to have as many events as that in the span of a few weeks, but still there's a lot of conferences, meetings, podcasts, all of these things. And I wanted to get your thoughts on how useful, the social side of things is great, right? Going to Omaha is such a great thing because you meet old friends and make new friends and all of that. But in terms of the investment, what does it add to your experience or skills or, your overall sort of toolkit as an investor? And the reason I ask is, one of my concerns is that I only end up going to places where I know that I'll find like-minded people who share a similar philosophy. Although, as you said, in Omaha, there's a wide range of ways to sort of implement that. But still, there's shared values, right? And I do worry a little bit that the only events I sign up and go to are events where I have all my views confirmed or validated. What do you think about? I mean, have you ever gone to any conference, a quant conference or any other conference where you sort of think this is, I'll be challenged here, or do you also see that sort of risk there?
I think it's a risk, but it is a wide range of characters that come to Omaha and all the other events that you mentioned. And I think there's a beauty in it that we come from so many different places, so many different perspectives. But back to your main question, in New York, there was always an abundance of events and conferences, and they were different in the sense that, there's no free lunch. So it means that if somebody's buying your lunch, it means they're selling something. And sometimes I would go out of curiosity. So just as a story and anecdote, I remember vividly going to an event that was promoting the 100-year Argentine bond. You remember that bond? A fixed income government, dollar-denominated, 100-year bond. Now, Argentina has an incredible record of defaulting or effectively defaulting on debt in the last 200 years. And there was a study, and I don't remember the details, but I think there's one or two countries that rank that high. And just Argentina, I think, is balancing at this very unique place where they earn huge trust and they lose all the trust. They earn huge trust and then... But anyways, I was sitting in that room and they were pitching that 100-year bond. And somebody in the room said, there's not like bad or good decision. It all depends also on your investment horizon. And if you were flipping homes in the US, in Florida, in the early 2000s when the housing market was booming, but you had all the intention to sell that house before the first mortgage payment was due within the month, you were pretty rational and very deliberate about your plan. But if you came into the same market and said, I'm going to be a long-term investor in this real estate market and I'm going to take a 5-year view, and it looked like it might be close to the peak with affordability, interest rates, and the whole setup, then you're in the wrong game with the wrong investment horizon. So if you bought that 100-year bond with an intention of holding it for 6 months, I think you would have probably been fine. Now, people that held on to it, and I don't remember the last quote on that bond, but I think it was down 60%, 2 years ago, the last time I looked at it. So anybody that bought that 100-year bond for a long time would have lost money. But anyways, this was one of those moments where I had no intention of ever buying that bond, but I wanted to go to see who would buy it and why. And the couple of remarks that I overheard and people I talked to, I realized I just have a very different investment horizon. I have a very different sensibility when it comes to risk. When I buy something, I buy it to own it. I wouldn't be the house flipping person in Florida. Kudos to them, whoever walked away with big winnings. And I think realizing that you go to rooms where you don't belong, sometimes to realize where you do belong, right? And I think it's interesting. When crypto was going crazy, I still took calls and I had interesting conversations with people that felt very adamant about crypto, and I never had any exposure. I had no interest. It's not my kind of investment, if you want to call it investment.
Yeah.
So I always want to remain open. And I read books about blockchain, 6-8 years ago. I was just curious. So I always try to keep my mind open, and people volunteer their opinions. And I think the hotter the market is, the more opinions there are. With crypto, there was a moment when everybody from a yoga teacher to a bartender to a big-time developer that I know were telling me that I should be in crypto. And it reminded me of those stories of 1920s before the market crashed in 1929 when the shoe shine boys were giving stock picks recommendations to some of the famous investors. I'm forgetting the names, who it was. Baruch. Was it Baruch? Maybe it was Baruch. And I thought, wow, the history rhymes, right? When a yoga teacher has an investment recommendation for me and you, I think there's something interesting happening here. And obviously we know how that ended, and a lot of those things went bust. And as we speak, I think Bitcoin has its return of some sort. I think the only survivor, but I still have no interest. But anyways, I think you make an interesting point that on one hand, you do want to be surrounded by people that share your values and principles. It doesn't mean they will own the same stocks that you will. I think it's actually rare that two people end up owning the same portfolio.
Agreed.
But it's also helpful to, from time to time, listen to the other side, whatever that side might be. And I just want to expand my horizon, my understanding, even if I choose not to participate. I don't have to be an expert in anything that I don't want to own, but I just want to know enough to say, this is honestly not for me. And that's how I see it. Some of those things might become part of my universe. I think that's how we grow as investors. And Warren is a great example. He went from very traditional industries, a textile mill, all the way to owning tech companies at the end, the last few years. So you can see this massive evolution in understanding of businesses and appreciating other businesses. So, you and I are still very young, and you could say that we're halfway or maybe 1/3 of the way. And if you look at Charlie, maybe 1/4 of the way.
Let's hope.
So I think it's understandable that you and I will be investing in industries that we can't even think of right this minute. I think that's the reality. And I'd love to remain open and eager to learn about those new industries as they come. And I wouldn't like to close off and say, this is it, and I'm not going to learn anything more. So I think having a nice balance between the two, it's helpful.
Yeah, I think that makes a lot of sense. So what I find is, and something I didn't appreciate, I think, when I sort of first came into the industry, is that it seems to me that there are two different almost segments or groupings in the industry, where you have on the one hand the large institutional, call it product managers, right? So, the asset gatherers and the hedge funds and all of that. And then by combined assets, of course, the second group is much smaller, but they're the kind of people that we may run into in Omaha or in Zurich or other places at the Markel meeting. And I like to think of it as more of a cottage industry, right? And so these are smaller, independent thinkers. They're more focused on, I think, having a setup that suits them and suits their lifestyle. And they're less concerned about how sort of commercially marketable the product is. But when I speak to students, I think they're often unaware of the fact that you even have that second group or second type of manager. Does that make sense to you? Have you sort of experienced a similar, I don't know if division is the right word, but sort of segmentation?
Completely different worlds when you think about it.
Yeah.
I think one is very sales driven and very product driven. And I interact with families that walked away from places where they felt that they were sold on things. And usually you're sold on not what you want, but what has not sold, what's still on this proverbial shelf sitting that they have to push because they have a quarterly quota and so on. So sometimes I'm shown a portfolio and I'm wondering, how does this even make sense? It looks like somebody was trying to stuff things that don't belong. And that's a very different world, but it has the reach and the distribution and the size and on. So it has a huge advantage, right, in terms of attracting assets and marketing power and all that. But you're right that if you look closer, there's a whole world of operators that in my world and in your world come from the family side. We're very close to the actual person behind the capital. It's not an institution, it's a family, it's individuals, it's siblings and parents and grandparents that I get to know. It's not about selling, it's about earning a trust, building a relationship, being in their life for a lifetime, and sometimes, being in their life through multiple of their own generations, especially if you can be in this business fairly early on, as I have been for the last 20 years, and I got to know the grandparents that are no longer with us, and I'm working with the kids and the grandkids. And you build a relationship, and you do the right thing, you care, and it's a whole different value proposition. And you and I talked about it, it's the pride in what you do kind of approach. But I think from the outside, it all looks the same. You look at this billion was invested and that billion was invested, and you could see statistically what's the difference. But the nature of the business behind it, it's not even a business, it's more of a practice, really. It's like a family doctor, right? And it's not about maximizing your profit. It's not about even growing as fast as possible. I actually take my time inviting new clients on board. I meet them many times. We have lunches, dinners, calls. I meet their children, and I just want to make sure that it's the right fit. And I feel like that time spent up front pays off many times over later on, where we realize that this actually could work, and I think we're on the same page, and I think they're ready to have a conversation, and then they can become clients. Somebody asked me about, lockups, like some funds have lockups. And I said, well, if the client and I realized that it wasn't a good fit, there's no reason for a lockup. Let's accept that it's not a match, and I wish them very well. Let me know how else I can help. But it hasn't really happened in my experience. It's more often the case that the family needs the money, or the money gets spent, or there are ideas to deploy that money elsewhere in some way, rather than there's a mismatch in that sense. And I think it's very important. It's a relationship building kind of practice rather than business. But from outside, it looks all the same. And now we have this whole universe of passive investing and ETFs that have trillions of dollars. So when you pull up a filing of any company and you see who owns it, right? You'll see you and me, right? Down the list somewhere. But then you'll see massive ETFs that own it. And, it's a whole layered conversation of who is the owner of those businesses, what are the priorities, and how the proxies are voted, and what kind of decisions are made, and on and on. I think it all translates. But for a younger individual, I think it's a very clear choice between a large institution that has, I'm sure, a lot to offer, because it's, it has the depth and the reach and the variety of people that work there, and then some smaller, but some of them are not that small. I mean, they could be of size. The first firm where I worked had 40 people. We grew it to 150 people. And I felt like the variety of managers and approaches that was available there allowed me to learn and figure out what really resonates with me. So I think you can find places that are big enough where you can truly learn and find your own voice.
I agree, by the way. There are certainly some medium to even large or very large managers that I think are incredibly impressive, and that are clearly, very exceptional investors. So I don't necessarily think that size means size disqualifies you. But equally, I think, when you look at the very large firms, like the Fidelities or the Capitals or those types of names, I do say to students, I think often they're good. They're a good place to train, right? You get a very sort of good structured training. You get international opportunities, and then later on you can consider moving to or setting up a smaller firm. Which brings me on to the next topic, because obviously there are some very exciting things, I think, going on for you at the moment, right, professionally, and I'm sure otherwise as well. But in terms of your, the professional side of things, I think you're making some changes, aren't you? So maybe we can, and I think it relates to what we just talked about. So could you, maybe share a few sort of thoughts around what are you doing? What are you sort of trying to achieve? How will you go about things? What might sort of change compared to what you have been doing?
It's a terrific question and perfect timing. So I launched a new firm. It's called Blue Infinitas Capital, and we can talk more about the name. I've been in the business 20 years, and I've been thinking really hard about the next 20 years and even more. And I was thinking of an environment, a setup that works for me and the clients that I like to work with. And I was looking for more, freedom, independence. And I think I always had a dream of having something of my own. And there's this saying that Buffett has, being a business person makes you a better investor, and the other way around. And I feel like as an investor, especially in the public markets, building stock portfolios, you learn a lot about a lot of businesses. And actually running a business, and I've been running a business for the last 8 years. I co-founded an investment firm out of New York with a couple of colleagues. I learned a lot about the actual business operations of an investment firm. And it's very eye-opening, because you go from a place where you get a desk, a phone number, and you sit down and you're an analyst, right? And the things you have to think about and worry about are very limited when you think about it down the road. when you're running an investment firm, you're learning so much more about in the ins and outs of trading, reporting, compliance, and on and on and on. And it makes you realize how all of that has to be organized and function. So launching a new firm in a way, from scratch, but not really, allowed me to rethink all the building blocks of the firm. And I've been really impressed with how much innovation there has been, mostly on the software side, that make things more efficient, quicker. So to me, time is the biggest asset, and I want to have as much time as possible to do my investment research, look for ideas, and then spend time with clients. So everything else that's not really core and value added, but just necessary to operate, I chose to outsource or find software that does it for me. And even in the last 20 years, I think there has been just incredible innovation, and even more so in the last 5 years. So when you have an existing firm and you want to switch from a platform to a platform, it's usually tricky. I remember some 18 years ago at my previous firm, I tried to introduce a new research software, and it was a bit of a rebellion where a lot of people said they don't want to switch. And some people told me...
It doesn't sound like a very rebellious act, but I think in this industry it can be.
But they told me, Christian, what is it that I can do with the software that they couldn't do when they were my age with a pencil and a legal pad? And I said, nothing, but I can do it in a fraction of the time. And if I do that, then I can spend time doing something else or reading up on something else. Time is really, and I think time and attention are two precious assets that we have as humans, and especially as investors. There's almost an unlimited number of stocks to look at, right? So you have to filter out how you're going to spend your time. And then when you're running a business, there's an unlimited number of tasks. So you really have to streamline your operations. I spoke with my accountant, and I showed him a couple of tools that I'm using that will streamline his work as he's helping me. And he was very impressed and very grateful. Those minutes add up. It's compounding at its best. And
then he probably went back to using his old software anyway, because that's also a very conservative business.
Probably. Change is a funny thing. I think until we're forced, we don't change. And I think it's a whole separate topic. But the last 4 years since the pandemic, I think we were forced to try so many things, and we got more comfortable with so many things. And in my business, for example, paper forms completely went away, at least in the way I run the business. And even my clients that are in their 80s that I was a bit worried about because they like paper, I would send them forms to sign, just a little anecdote. And I would call them to follow up to say if they have it. And then they said, oh, yes, I opened it on my phone. I just signed it. It's done. And it just put a smile on my face because I just saved not just my 3 hours, but I saved their 3 hours, right? To go to somewhere, to print it, to scan it, all the pages, and make sure they all get scanned. Sometimes the scanner skips a page when they're too close to each other. I'm sure it happened to you in your lifetime. And then you have this moment of, I took up only 5 minutes of their time, right? 3 hours times that many clients times that many days. I think, I'm saving lifetimes here of time that it can be spent in some other way. Just a simple example, but so these are the operations. Now, the big picture idea, I continue to work with families. It's patient, discipline, capital. The name is Blue Infinitas. I sail and I was
going to ask you about that.
Yeah.
What's the sort of origin of that?
Inspiration. So my wife, Megan, has been very helpful on the visual side, marketing side, and branding side. It's her background. She worked with some big brands, and she's helping a lot of businesses these days to tell their story. And we had this big brainstorm session that brought us to the name Blue Infinitas Capital. Blue is because of the blue open horizon. I fly and I sail, and I always thought of this blue open horizon of this open-ended opportunity, promise, and all the things that are ahead of you, which I see as wealth and compounding. That's what it is in my mind. And infinitas, it's a Latin word that means infinity. And on one hand, it's a dead language. So it's paying respect to the past. The capital is with us because of all the decisions and choices that have been made before us, or the wealth creation moment, time that happened. So that's important to me. And then infinity, because I see family wealth as capital that has an infinite investment horizon. When you really, really think about it, and if you have a family fortune that's meant to last your lifetime and hopefully many other lifetimes after that, your investment horizon becomes close to infinite. In an ideal world, you would like that capital to last. And there are certain things that you can do both on the risk side and obviously on the reward opportunity side that you can do, a certain framework that would allow you to have both respectable returns but never risk losing it all. So that's how the name came about, and that's the big overarching philosophy, helping families keep and grow their wealth over generations to come. Very patient, very disciplined, and the biggest advantage we have is that infinite time horizon in front of us.
That's great. And I will get back to some of the sort of specifics about, how you invest and how you will invest going forward. But, and clearly you've thought about the name very hard, Bogumil, so I'm impressed. Just before we get to that, I wanted to ask, and this is sort of to do with how to spend your time, and I guess it, this could be sort of relevant, I guess, at your new venture as well. But the idea of reading, and it goes back to Charlie, the idea of reading versus thinking. I thought it was interesting that I think it was an interview with Aswath, the mod run, where someone asked him, what is your learning from Charlie? And he said, interestingly, my learning would be read less and think more. And I thought it was so interesting, something along those lines. But it's interesting because I think most people associate Charlie with this idea of reading, right? And there's so many stories about the number of pages that Buffett reads, or the number of books this and that investor reads, and I just wonder, how do you feel about this? Do we have an excessive focus on the amount of reading that goes on, as opposed to the amount of thinking and reflection and just sitting in a quiet room and thinking about business or investing? And maybe it's a slightly leading question because I somewhat sympathize with that idea, but I'd love to hear your thoughts, and how do you sort of deal with that balance between reading and other inputs, and on the one hand, and sort of processing that and reflecting and coming up with ideas on the other hand?
I think you absolutely need both. For me, what's been helpful was writing. And I started writing from the beginning, and I always liked writing. I actually wrote articles for a student newspaper way back, and I always enjoyed writing. And as an analyst, I would write up stocks, obviously, and present ideas. So that was a great example of practice in organizing your thoughts and then introducing somebody else to an idea that they might have never heard of. And the crowd was not always very receptive. If anything, and it's the contrarian bone in me, when the audience was less receptive to the idea, I thought I'm onto something. Because when you find an idea that everybody loves, and it's on every cover, every magazine, I feel like there might be less of an advantage there, and it's too obvious. So writing has been a big part of my experience, and about 10 years ago now, maybe a bit more, I started to publish or share what I write, which is a different experience when you write it for an open-ended audience. Obviously, for compliance reasons, you can't mention certain things, particular stocks. That's the case. But you can talk about the principles, the philosophy, how your thinking is evolving, and then you get the feedback from people. So you continue to learn, and it's that pause from reading to actually sitting down and writing it down. And the minute you actually see what you wrote, you perceive things in a different way, and it kind of slows you down. It gives you a chance to digest. And I like this idea of writing in a way that takes into account that you will not be in the room when whatever you wrote is read. And it's very interesting. It's very different than writing a stock report and then presenting it to an audience, the investment committee, and being in the room when they read it and you say, no, that's not what I meant, or this is supposed to be that, right? Like you have this live feedback loop. But when you write an article or a book and it goes out to the world, you're not in the room. So you have to give, or I try to do that, make an extra effort so that the actual content falls as close as possible to what I intended. And then obviously I have to surrender because people read it through their own perspective, their own experience, and they perceive it in their own way, which is beautiful in its own way as well. But you have to, I try to make sure that this is as precise as I can be. And I notice that sometimes the phrase, the choice of words, and can create a certain shift in the perception of what you're trying to talk about. So I'm trying to be as specific, as precise. But I like that idea that I do the reading and the study, and then I sit down and I write it. And now the podcast, the last year or two, has been another way to create this flow of ideas. A client asks me something and I ponder. And then I have a conversation with somebody on the podcast and it's still on my mind. And I bring it up and I get a slightly different perspective. I obviously, it's all, I mention it more as a case study or as a very general problem so that somebody can shed more light on something that I'm thinking about that came up in a conversation, and that flows to an article later on, and I can bring it up in another conversation. So it's this never-ending learning experience of flow of inspiration and ideas. But I think you have a great point that at some point you have to close the book and think about it. And just going to the next book and the next book doesn't really give us a chance to just pause. And writing really slows us down and gives us an opportunity to think about what we wrote. And I don't know if you have this experience, but if I go back and I read something I wrote 5 or 10 years ago, or even sometimes a year ago, I have this feeling, is this really me that wrote it? Obviously it was me, but I've changed. We all change, right? So we have a slightly different point of view with every moment. And I had a great conversation with Chris Mayer about this idea that, you and I say that this is me, but the me from 2005, is that still me? And if the me of 2025, I don't know, 2050, is that still me? And we will continue to change.
We're getting into very difficult questions here, Bogumil.
But writing is kind of a snapshot of me today. That's what I'm thinking. And it's fun to go back and see that snapshot.
Look, I think there are two very good points. Obviously you have the opportunity of having these conversations in, whether it's in a podcast format or at a conference or what have you. And then also, as you said, I think writing is a way of processing all of the material you consume, right? I think for many, and especially my experience from when I worked in the institutional world, is that very little of that takes place. So it's all about inputs and impressions there, and it's very little about the processing. And so I think it looks very different when you look at many of these sort of small to medium-sized independent managers, family offices, where I think there's much more of reflection and processing going on. And I think it's unfortunate, and it's important to consume a lot of reading material. But I think, and I especially say to students early on in your careers, you want to be reading widely, and then as I find increasingly I reread things. Right. But I think it's almost unfortunate, this sort of emphasis on how many books have you read this year or how many pages do you read each week, because, that's important. But the processing is equally, if not more important, I would think. But anyway, look, let's talk about wealth creation versus wealth preservation, because I think we've talked about this before, how they're two slightly or even very different activities. So one of the things I wanted to ask you is, given your extensive experience of working with families, and you document this so well in your books, Money, Life, Family, and some of the other writings, how many of these families have sort of fortunes going back hundreds of years, right? Do you see, and in some ways there are never easy answers to these questions, or there are never very sort of straightforward rules, but do you have any general learnings or sort of principles that you see families who manage this successfully that they apply And perhaps more interesting, do you see in those families who haven't, although I guess they wouldn't necessarily come to you because there's no money to invest any longer, but what might go wrong here? What are the big sort of dividing lines here?
I think it's a terrific question. So let me start with the fact that if there is a family fortune that's been around for more than 2 or 3 generations, it's more of an exception than a rule. And I think there's
Yeah.
this moment of admiration, revelation, and you can even say, wow, like that we have something to talk about after so many generations. And in the book that you mentioned, Money Life Family, I studied families that are well recorded and well researched, and then I also have stories from my own professional experience. And obviously, I don't mention any of the families, but the lessons start to rhyme. The more cases you see, they start to rhyme. And I'll mention a couple of threads or big ideas. So the wealth creation usually happens in one single business.
Yeah.
That's kind of a rule. Usually it's a one single business. And if you look at it, there were some special circumstances that allowed that business to grow, flourish, succeed. And if the timing is right, the family might have sold the business and came to the realization that they don't want to manage that business anymore, or maybe the price is so attractive that it's time to part with it, whatever might be happening, but they part with that business. And it's a massive shift on so many levels for the family because there's so much identity tied up with that original business. And that can go on with the family stories and the legend and everything else into the next phase, which is a portfolio of investments. And it doesn't have to happen overnight. Sometimes it's a gradual thing. And I've seen many stories where it's the real estate investments that kind of grow on the side of that original operating business. They might be even somehow some real estate holdings that are related to the original business, warehouses or land around the original manufacturing, and on and on and on. Mm. But some of those gravitate towards other businesses, and some families end up in the same industry that they know, and some of them take a leap and go to other industries and then build a portfolio. Many of the families I work with have long sold the original business, and they've been in a portfolio of investments, very often in my case in publicly traded in stocks. That's what I do. I manage stock portfolios. So there's a portfolio that now, kind of like this big energy flow that came from the original business, that continues its life in a variety of businesses. And I like this image of, we spoke about the infinite investment horizon, but the assets are finite. And I think you and I would agree that a lot of businesses have only that much time at their peak performance, right?
Yeah.
And I mean, studies show that it's about 18 to 20 years that any business on average, averages don't tell the whole story, but just for the sake of the argument, that it takes about 20 years for the business to be at this peak. And it's not all linear, and they may have ups and downs, but anyways, the 20 years when you provide the most value. And when you think of the portfolio, you think of having as many of those that are in that stage of continued wealth creation. But it's not one single business. The other big theme that I would mention is the location. And maybe in some ways I'd like to start with it. So the families I've worked with, they, one way or the other, had assets in the US. And they might have been families that are based in Europe or have lives between Europe and the US, or families that have been in the US for many generations. But somehow the one thing in common that I found was that they had some presence or some exposure to the US, or the only assets that lasted were in the US. And it kind of started to rhyme again and again and again. So it's not a rule. Maybe it's one of the paths. And there are families that preserve wealth in Europe, and there are families that preserve wealth in Asia. But somehow a lot of the families I got to work with have benefited from 200 some years of peace and quiet in the US, obviously with a civil war and other engagements. But other than that, it's been a country with pretty stable governments, respect of property rights. So if you own it, you truly own it. And limited conflict except for the civil war on the continent itself, in the country. And a very business-friendly environment in general. It has evolved and changed, but I think it's a very business-friendly environment, massive market with a very developed stock market, and on and on and on. I grew up in Poland, and Poland went through massive, transformations in my lifetime, but also in the last 100 years. Two world wars. Poland was actually not on the maps until 1917, 18. It lost its independence in 1795. So it was divided by the three powers next to Poland: Austro-Hungarian Empire, Germany, and Tsar's Russia. And then you had two conflicts. And then if that wasn't enough to lose wealth, then you had 45 years of communism, which was an economic experiment that assumed that we don't need a free market to operate, that we can have pretty much one owner of all the assets in the country that employs everybody, and somehow everybody is happy and people were not. But anyways, that was one more way to part with your wealth, one way or the other, through confiscation and loss and lack of opportunity too. So having the US as an example, it's an extreme end of the range here, right? Like that one country that basically had all those different events, historical events that led to wealth destruction and confiscation and loss, and a country that allowed this environment to continue and continue. I get to meet families that have inherited some mineral rights, usually oil royalties, that go back many, many generations. And the fact that when you think of it, that they still collect some sort of cash flow from an asset that the great-great-grandfather had, it's mind-blowing to me, because that's something unheard of. The only story that I can share in my family that I brought up here and there was that my great-grandfather bought a piece of land next to a pretty park in a small town before World War II. And that piece of land is still owned by some family members. So I think of it as something that had this continued ownership, but it was more of an exception than a rule. So he had documents that were still honored in the 90s that he actually owned that land. And I counted how many generations had stayed at one of the homes on that property. And I think it was 5 or 6. So great-great-grandmother might have stayed there at some point, all the way to great-great-grandkids that are much younger than I am today. So I was thinking 5 or 6 generations of the family have some sort of touch and experience with a small piece of land. But that's the closest I can get, and it doesn't compare with the fact that somebody owned some massive mineral rights, oil royalties somewhere in the US for so many generations, and it's still theirs, and nobody will take it away. And so that's important. You talk about loss, and the Vanderbilts are probably the prime example that's researched and written about. And I think a couple of things can happen, right? Some of them are internal and some of them are external. And I think we spend so much attention on the external, the taxes and inflation and wars. And I think that's important. But I think there are a lot of things that happen within the family that can undermine the long-term success. And the big thing is overspending. And the second one is poor investment choices. And I'll talk more about the two. But there is this idea that certain lifestyle might be too expensive even for the rich. And I had Guido Alfani, who is a historian of the super rich in Europe, who wrote
I got the book.
He got the book, yeah. Fascinating guy, and we had a fun conversation. And it happens again and again in history. Like the more you zoom out, the more you look at the big picture, you realize that what feels like it's unique to you and me or this family or that family, it actually happened again and again and again and again. So I think it's fascinating to look back and learn from it. Charlie told us how we can learn from history. And I think when it comes to wealth, we definitely can learn from history. And there is this moment that Vanderbilt also faced when they had to maintain an image of such a rich life that they could not afford that life. And I had Fraser Rice on the show, who works with wealthy families out of New York. And we talked about this concept that really hit me. He said that even the wealthy have to find a way to live within the confines of their wealth. And I thought that the word confine or confinement is the last word you want to think of when you have substantial wealth, right? It's the moment, listen, I made it, especially if you just sold the business and you feel like, what do you mean? What confine? Finally, there are no confines. But the lesson is that no matter how much we're talking about, it is a confine by itself, right? A household that has, $100,000 annual income, that's the confine. But the household that can collect 20 million in dividends and income and maybe some, appreciation every year, that is a confine. And I think that's something that we have to realize. On the investment side, I think the trick is to realize that your risk reward metrics have shifted. So if you go from wealth creation to wealth preservation, and when I say preservation, the wealth will still grow. If you have substantial wealth and a very open-ended long runway, you can still compound that wealth and see it grow. I mean, the 5 to 15%, let's say, can get to a very large number after 50 years, more than you probably need. And so there's no rush. But I think the realization that there are certain risks that you cannot afford to take, and it can be poor investment choices, very concentrated investing in very highly uncertain investment choices, and on and on and on. I like this idea as a rule of thumb that I say that I don't want to have any zeros in the portfolio. So if I see an investment opportunity and I can imagine this idea going to zero, I don't want to own it. And there are a couple of things that can happen. It can be a secular decline in the industry, a lot of debt, questionable management. Really, there are the three buckets that a lot of those fall into. The reason I don't want to have them, and you could say, well, can't you just compromise and have 5% of the portfolio in potential zeros? The potential zeros are appealing because they are kind of like a lottery ticket. They can go to zero, but they could go up 100 times. So it's very, very tempting. But I choose not to have them because there will be a time when so much of the portfolio is in the potential zeros and all the wrong things line up, like they did, for example, in March of 2020, and they did during the financial crisis and a couple of times since, when too many of those potential zeros are dancing close to that zero. And that's not something I want the families to experience. I would call it, a game over. I had Luca Delana on the show who writes about game overs, and that's something I don't want to have. A lot of ideas here that I shared with you. So dive in into.
Let's get personal here, Bogumil, on that, because I think you write some. No, I'm curious about this. You write, I think, about your family history, and I think the expression you use it, fortunes made and lost, right? And
yes.
So I'm just curious what you're referring to the extent you're willing to share this, and I guess also. And it's related to this next question. How come you're interested in, let's call it wealth preservation and sort of gradual compounding as opposed to aggressive capital growth? Because I think, I'm in your camp, but most people who come into the industry, at least sort of early stage, almost everyone is interested in the sort of aggressive or high rate of capital growth. And then some people transition to a sort of compounding mindset. So, what was it like for you? Was that always your mindset, or has that been a transition? So I guess there are two questions, your personal experience, your family experience, and then is that sort of what drove this mindset?
I think you just built a beautiful bridge between the two. I think my family experience shaped me in a certain way that this is the only way I could see investing as a way to have the slow and steady way of growing wealth over time. And I always thought that I have time and I have a runway. And I always thought that if I do create substantial wealth in this lifetime, it's very important for me not to lose it. I think that was very important for me. And it's this overarching idea of starting with zero or close to zero. And, we have this concept of living paycheck to paycheck in many places on earth. And it's surprising how even in the developed world, how many people live paycheck to paycheck. But then taking it to the next level and seeing that each generation starts with zero. Why is that? I spoke with somebody about Sisyphus and pushing that rock up the hill, and the famous myth. And we kind of do that with every generation. Every generation builds something up, and somehow the next one starts with zero, and we do it again and again and again. And I think there is a beauty and an opportunity in breaking that cycle. And obviously these days we have people that start with a negative net worth because of student debt, especially in the US, which is a whole topic in itself. But anyways, I think I was very curious about the ways to preserve wealth, and going decade after decade back, kind of telling the story. But the 90s, after communism ended in Poland opened up. So it was a massive free market economy, booming, kind of a Wild West, and huge opportunities. And I was a teenager, so I was just watching. But new businesses were created, and people would overnight get very wealthy compared to their neighbors, and nicer cars, nicer homes, better travel, all those things that are more visible. But also that success was very short-lived. After 5 years, competition came in. There were too many of certain stores or whatever business they had, and that wealth disappeared. And obviously the market itself was tiny. It just reopened in 1990 after a almost 50-year break. So I saw a lot of wealth created and lost very quickly. So that was one thing that really hit me, that it's not really about getting rich, if that's your goal, but about staying rich or staying affluent or staying comfortable past that point. But in my family, going back, there are those stories, and I'm thinking, you have 2 parents, you have 4 grandparents, you have 8 great-grandparents, and then 16 and 32, right? So when you hear those stories, you try to think, how many branches back is that, and how that all fits into the picture. But there were those stories of certain affluence and comfort, especially before World War II in my family. And I heard stories about home libraries with French books, for example, which only some people could afford, and certain travel that they could afford back in the 30s. And so I could hear those stories, and as a kid, you don't know the meaning of it, but I could hear those stories from all those different branches of the family, and different offices that they held, and different properties that they had, and I could tell that they were affluent, and for various reasons it was either lost or confiscated, or they had to sell it, they were forced to sell it. So the only thing that really stayed was both that kind of spirit and this affinity for education. And from all the branches of my family, as far back as I can see, education was something important. And I found letters of my great-great-grandmother, and she was writing, and it wasn't even very common for women to be able to write back in the day, 100, 150 years ago. So there were women in my family that clearly were educated, and they were making some decisions, and some of them, they were long-living widows in some cases. And so I would hear those stories, and I thought there was something that was lost, and if what was lost, if we ever have it again, what can we do not to lose it? And that story rhymes with a lot of experiences that some of my clients have had, or people that approach me have had, where even if they have substantial wealth today, there are those legends that they had even more in the past, which is something that's not talked about. But they might have something that you and I today, or an average person, would consider substantial wealth, but they say we could have been 100 times richer for that or this reason. And different things have happened, either self-inflicted choices or poor investments or spending or some political shift because of where the assets were. And I think there's this shared human experience of something that was there that could be restored. And I think that's been on my mind. And I think that's why when I chose investing as my lifelong pursuit, it wasn't just to find stocks that go up, as much as I still find a lot of fulfillment and excitement in that. But I saw it as a bigger picture idea. If we do create wealth, or if we are responsible for that wealth, what can we do to see it grow but never lose it again? And what are the different components? What are the different things that we can do? You can't secure your success, but you can really improve the odds of success if you do certain things in a certain way. So that's been my lifelong curiosity and study, research, and even in a way, obsession. I'm very, very curious. If somebody tells me a family story, I was just sitting down with somebody yesterday, and my podcast invites a lot of people to reach out, and
I'm sure.
they feel that they know me, and I think they do after listening to those conversations for sometimes a year or two. And they share incredible stories of their own family experience, of family wealth lost and created and preserved and saved, and it resonates with them. So the whole world is full of stories of family wealth, and I think we can all learn from each other and figure out a way so that the next generation doesn't have to start from zero. I think it's so empowering to think that there is something that's there for you so that you can make different decisions. Maybe you can take a gap here. Maybe you can postpone which industry you're going to choose. It just gives you freedom and opportunity to live your life in a way that comes from a much more relaxed, calm place. And I think it's a wonderful gift that one generation can give to the other.
Because one important question there is, how much is enough? Because, so for instance, I have a number of friends, people I know from when I worked in the institutional world, and they would say to me, "Oh, I'd love to be doing what you're doing today, run a permanent capital vehicle." And I think to myself, well, you could be doing that, because in many cases these are people who have significant amounts of capital, and much more capital than I have, to sort of work with. And so I guess there's this idea of knowing when it's enough, right? And I'm sure that number varies for different people, but without putting a number on it, the kind of families you work with, where would they normally, is there a very wide range, or do you tend to, the people you sort of families you refer to, are they in a situation usually where there's no sort of question, or there's no sort of difficulty making that definition or distinction? They're already clearly in the sort of compounding preservation mode, or do you have some people who are where you're even having to sort of assist in or help make that decision on whether they should still be growing their capital more aggressively or not?
I think it's a great question, and there are a couple of ways to approach it. So I've devoted my time to clients that are already comfortable, and they're not thinking about creating wealth in a short period of time. I feel like there are other people that maybe can help, or maybe they can be still focused on the operating business and so on. So the families that join me are families that the capital that they provide, that they have available, is the capital they don't immediately need, which I think is very powerful, because that's as close as you can get to the permanent capital that you bring up, that allows us to make certain choices and actually wait, and they can't afford to lose that capital. But if you were to put a number, I think something unique happens at a $5 million mark. And I don't know why, but if I was to really boil it down, I think something interesting happens at that point, and even more so at a $10 million mark. Until that $5 million mark, it feels like there's this rush. The first million is just not enough. That's the sense. And they have to find a way to get to 5. And I think it might be the hardest journey. Munger said that saving the first 100,000, and I don't know when he said it, so I don't know what the 100,000 was at the time, but whatever it was, he said that first 100,000. He said, walk everywhere, use coupons to buy beans, and whatever you have to do to have the first 100,000. But I think past that 100,000, I think the first million, it's an interesting point, because you feel like you're in this new sphere, but you're not yet truly comfortable. And I think something really interesting happens at 5 and at 10. And then in tens of millions and hundreds of millions, I think you have more options and more choices. And I think the biggest thing that those clients have in common is that they're at ease. They're no longer in a race, and they're at ease. And everybody reaches that point at a different point, a different amount. And I think some people never reach it. They might have 100 billion and feel like they have to negotiate with their company to give them another large pay. I'm not going to mention names, but there's somebody out there these days who's getting a lot of attention, who's negotiating a big big pay. And I was reading more about it the other night, and I was thinking, why? At this point, it's a why question. But anyways, that's a whole separate topic. But I think we all find that point. So most of the families I work with, they're more than comfortable. They're at ease. That they are thinking about the long term, and they reach that point, and it comes up in the conversation when I can tell we're no longer in a rush, and we can have this kind of a discussion, and we can plan for the long run. And the holdings we're going to have, and the way we're going to invest, and the way that the stock portfolio will work, it's very different than you tell me that you have a 6-month investment horizon. I just don't know how to help. I think my writing has inspired a lot of people that have started in investing or thought about investing. And when I say that, it doesn't mean that they have to be stock pickers. I think you can participate in the success of businesses through, passive methods and so on, especially if you make contributions over a lifetime. So I think my writing inspired more people that I can possibly physically, serve as an investment advisor, and it makes me happy. And I think the podcast does the same thing. And then a smaller group of people, I can really commit my time and attention, and it has to be a more meaningful amount of capital, and they get my full attention, and it's a very different experience. And I'd love to maintain that kind of mindset that I think by definition it has to grow because what you do attracts more people and more people recommend you to more people. So by definition it's growing. But I'm very focused on how I spend my time and how many people I can give the kind of attention I want to give. And I think I want to be fair to everybody involved so that I don't spread myself too thin. But everything else, it's just, fills in the gap and allows other people to have a little peek at how people think. I think this conversation and you bringing up those topics today, I think it will allow a lot of people, both young individuals that are thinking of a career in investments and maybe a family with substantial wealth, to think of, I could be treated much better than what I've experienced so far. Maybe there's somebody else that's doing it differently. And I think it opens eyes. And once they see it, they can't look back. And they start to gravitate to a whole different kind of money manager, financial advisor. And the things that you and I talked about, somebody that's not in it just for the money, somebody that is absolutely obsessed about it. It's their calling. They have to do it. And somebody that truly cares about you. I grew up in a household with two doctors, physicians, and they was their calling, and they care. And you want to have somebody holding your hand at the end of the day and say, Christian, I've been doing it for 20 years. I know exactly what you need. Here is what we do. And I know everything about you that I have to know so that to make sure that this is the right decision and the right time.
Can you just give me a couple of examples of the kind of questions you would ask? So this could be for, presumably this happens before they become clients, but not the full list, but what are the key one or two things you want to find out? And also, I'm curious because, I have some sort of idea what rate of return, what kind of compounding rate I want to achieve over time. Do you do that with your clients? Do you sort of put a number on it? And will that number vary between different clients? And will that then sort of inform, different ways of investing their portfolios?
So a couple of things here. So I broadly say, there are no guarantees and no promises in this business, as you can tell, right? And the last 20 years, the next 20 years, we're yet to see how they will develop. I'm very optimistic, and I think there will be all kinds of opportunities we can't even think of in the public markets and probably in other assets too. I think of it as a 5 to 15% return. If I can double the money in 5 to 15 years, again and again and again, I think it's a sweet spot. And obviously there will be better years, and maybe we'll get better results. Maybe we'll have some subpar prolonged periods. That's part of it. But I think it's the journey that matters, why we own, what we own, the fact that I know the clients and I know the investments. There's no middleman. I think that gives me peace of mind, gives them peace of mind. In terms of particular questions, I see it as a moment of discovery. If somebody's really intrigued by what I do because somebody introduced them to me, or because they discovered what I do through the podcast or writing or the books or something that somebody shared, I give them and myself a chance to get to know each other. And I want to hear where we're coming from. Where are we? What is it all about? And it's really almost storytelling. And there are moments when I sit down with somebody and they've listened to everything that I ever recorded, and they talk for 2 hours without letting me say a single word. And they share this entire picture. The grandfather did this, and then we did that, and then my brother and I did this, and now that's where we are. And I get this very vivid picture. And through those stories, I feel where we are. I feel the moment when they realize they need somebody like me in their life and we can have a conversation. But I still invite them to sleep on it, and I say, I'll be back in town, or let's schedule another video call, or whatever is convenient. And let's have multiple those touch points where we can see each other in different circumstances. But to be honest with you, Christian, I think the best test in terms of onboarding a new client is living together through a market drawdown, through a sell-off. And I think, a lot of people get attracted to investing or want to have their capital invested because they think about the growth of that capital. But you and I know that the other half of the experience, and ideally that doesn't happen often, but it does happen, that the market is not going the way you thought. And there is a sell-off for whatever reason. We had in the last 20 years a couple of those, and they're 30, 40, 50% at some point. And hopefully the portfolio is structured in a way that we don't go down as much as the market. That's the aspiration. But actually going through it, it's that academic approach. We can be very hypothetical about it. What's your risk tolerance? And you're going to say, I'm fine if the portfolio is down 20%. But actually sit down with somebody and look at the portfolio and say the assets are down 20% according to the market prices today. And being in the room with them and having that conversation, I think nothing replaces that. No book, no academic research, no statistics, and actually being in the room and seeing how does it feel? And in a way giving them the confidence and courage to hold on to what we have. And you and I talked about it at the beginning. It's not just that you bought the right thing, but you're going to hold on to it. And in March of 2020, I took a wide range of calls, both from my clients who told me they just wanted to hear my voice, and they said, get back to it, we know what you're doing, which felt like a pat on the back and a nice endorsement that they can read my mind, that I'm buying things. There were stocks down 5, 10, at 5 or 10, 20-year low at the time, and I was buying things. And then I took calls from people that I respect, who are seasoned investors. And Christian, I think that experience broke them in a way. They said they don't want to go through another 08, 09. And these were heartbreaking conversations, and they told me in March of 2020 that they sold out of everything. They said, I just can't take it. And they're smart people, they're experienced people, but investing is also an emotional pursuit. And they were very honest about it. They said, I just can't take it. And these are the moments where I think you make the biggest difference as a money manager, both in terms of managing your own money and especially other people's money, where you can give them the courage to say, we know what we own, these are the reasons why we own it, and we're happy and comfortable holding on to it until we reach the other side of whatever it is we're going through. And looking back, everybody says that this was obvious, that the market will recover in the second half of 2020. No. I wrote articles about it that I put in a book so that I never forget. Because in that moment, I was surrounded by people that had a lot more experience than I did, and a lot of them just could not take it. It's a very, very tough pursuit, and you really need a stomach for it. And what really, really helps, I think, is that big long-term vision. What are we actually building? And how much of what's happening right now is just a small blip on a much bigger journey that will take us out of this very uncomfortable moment. And when you're thinking of a family fortune and infinite investment horizon, March of 2020, it's a forgettable moment, almost forgettable moment when you think about building something that could last 100 years. Very, very uncomfortable in that moment, but in the long run, a great buying opportunity for those that can tolerate it. And in the grand scheme of things, those things will happen again and again and again. And living through something like this with clients, as uncomfortable as it is, I think we both learned a lot about each other. And in a way, I think it was a blessing, although it didn't feel that way in the moment.
And what about the idea of running external money as opposed to just running your own money? Do you think that would change anything? Because we talked about this idea of permanent capital, which is so popular, right? And I like it, clearly. But then there are some people who very successfully, invest other people's money, and it doesn't seem to impact the way they invest. So, and actually March of 20 is probably a good example. Do you think, if you were just running your own money, would that have changed anything?
I think the shortest answer would be no, because I treat my clients' money the same way I treat my own money. I think of it this way, that a couple of ways, but let's start with one. There are some pursuits where you would like to be your own client when you think about it, right? In investment profession, when you really believe in it, you're really in it, and you have your heart and soul in it, you would love to be your own client. And there are other professions where you would rather not be your own client. You know, a brain surgeon or a great defense attorney. A great defense attorney never would like to be his or her own client ever, right? Like, you know, no matter how good you are. So, but in the investment profession, there's this beautiful alignment, and we spoke about alignment quite a bit here, where if you think that those investments make sense for you, they make sense for your clients, especially if you have this, and I think you pointed it out, how because of my experience, because of my stories, I align with this idea of slow and steady growth of capital. So I would invest the same way. I think something interesting happens when you manage other people's money, because you take on a huge responsibility and you earn their trust, and it's a big commitment. And I think it makes me take it even more seriously if I wasn't taking it seriously enough, and I am. Because I know that I'm not just doing it for myself, I'm doing it for other people, and it's all the money that they have, or it's a big portion of what they have, or it's a very meaningful amount for them. And I take it very, very seriously. And it's not a product, it's not a strategy, it's really a long-term vision for this kind of wealth. So that's important to me. The one more thing I want to bring up, I asked actually Guy Spear about it, because I told him, you know, managing your own money, managing your family's money, and managing other people's money, kind of three different experiences. And he told me a story that really resonated with me. There was this moment when his father was giving him more capital to manage, which was his family money. And he honestly told me, Bogumil, I was shaking. You know, it's if you actually realize what kind of responsibility is placed on your shoulders, you have to be shaking a little bit to realize what kind of responsibility comes with the fact that you have all that money entrusted in your hands. So I think I find beauty and fulfillment in the role that I can play in the lives of the families I work with. And as long as I can maintain this alignment between the way I think and the way they want me to operate, I think this is a very fun pursuit, but also very fulfilling, and it just all remains in sync. And I don't think anything would change if I was just managing my own money. If anything, I feel like because there are other people involved, I have to write about it, explain, and I get more questions. So if anything, it kind of improves the overall experience, because there are other eyes that are looking, thinking, and feeling all the things that are happening around us. So I find it very, very fulfilling, and I'm very grateful that I get to do it this way, not just with my own capital, but also with other people.
And how do you, we talked about, I think when I was on the show, we talked about benchmarks, and I think you asked me, do you care about benchmarks? Do you pay attention to them? And so now I'll ask you the same question effectively, because somehow you need to assess performance, right?
Yeah.
And I'm not saying you have to assess performance relative to a benchmark, but, you know, you want to assess your performance, and I'm sure your clients will want to assess, you know, how are we sort of meeting the objectives. So what do you look at apart from, I'm sure if you put a number down on a piece of paper, I'm sure over time you compare outcomes to that, but do you also look at anything else? Do you look at any other measures like volatility or drawdowns or relative performance, or how do you sort of figure out whether you're doing your job?
So the danger of doing those fireside chats is that my guests remember the questions I asked, and then
absolutely.
So I asked you, what would happen if benchmarks were never invented? Let's say that the Dow Jones was never invented. Would you do things differently? Let's say we're living in a world where benchmarks don't exist. And when you really think about it, what are we trying to do? We have a certain capital, we have a certain investment horizon, we have certain people behind that capital, and we're trying to grow it. And what kind of growth makes sense? Obviously, covering inflation, purchasing power, all that, but also committing time, right? I'm thinking, it will be decades and decades. So what really makes sense? And I mentioned the 5 to 15% as a rule of thumb. That's the aspiration, and I hope we exceed that. There are no guarantees, but that's the aspiration. I think it's a very decent mindset of doubling your capital every 5 to 15 years. Now, you touched on something that's very important, which is the drawdowns. When you really think about it, and you might have noticed that in your own experience, and I think it's just a human condition that when you look at the portfolio, and these days you can pull up your portfolio on all devices, I think too often and too easily, but somehow our minds get locked in on the high watermark. You know, people look at it now and they say, this was a $20 million portfolio.
Yeah.
And the funny thing is that most of the time, the investor will be below that high watermark.
Yeah.
By definition, right? But most of the time, we're somewhere below it. Because it's rare that the portfolio is going past that point, past that point, past that point forever. Actually, there are long periods when you're like 5% below. And there's something peculiar and funny that happens around some milestones. And I think the milestones are meaningful. We talked about 5 million, but let's say it's 20. And then, God forbid, it's at 18.5 for 6 months. There's a certain pain in there that pops up. And to be able to ignore it in a way and accept that you will be below that, because 20, it's such a memorable number, and 50 is a memorable number, and 100 is a memorable number. But anyways, when you're below it, I think there's a certain discomfort, and I think we have to learn to live with it. But I think the bigger question is going through an actual, bigger, meaningful drawdown. If you have substantial wealth and you're living within the confines that we talked about, you have the 100 million or the 50 million, the fact that that portfolio drops down, 20, 30% has really no bearing or impact on your day-to-day life unless you're really overspending, right? Most families would not even notice the fact. They look at the portfolio, well, we'll wait. And I think that's the most comfortable and the ideal situation from both the investment perspective, the family comfort perspective, that it doesn't affect their life if we're going through a drawdown. I'd like to tell clients that when you look at the portfolio, it's not just the stocks that are in it, but also the ones we chose not to have. And that doesn't seem to matter most of the time, but it really matters in times of a massive drawdown, because the things that we chose not to own are the things that are down 80, 90, sometimes 100, close to 100%. And so much, wealth, paper wealth just evaporates momentarily in moments like that. And we've seen it time and time again. And I'm certain it will happen again. So when I look at the portfolio, I say, the things that we don't own, and I pay attention to it, and I hope you do too. But there will be times when it really, really matters. So that's why I say that when we do have a sell-off, the things that will go down 90% will not be in the portfolio. That's my mission. And I certainly hope that it's not just an aspiration, but it's my mission not to have those near zero experiences in the portfolio. So in a drawdown, I would love us to be down less than whichever benchmark you are looking at. And the big picture idea is the journey itself, right? You're aiming for some returns, but how do you get there? And the less discomfort you create on that journey, the better. So that's how I look at it. I manage separately managed accounts. So it's not a fund. It's a registered investment advisor. And I can have some flexibility for individual clients that want to have a bit more fixed income or cash in the portfolio. I can have that flexibility. And in some cases, something that's maybe not discussed enough, but many families have some legacy positions that have very low cost basis. A grandfather left a stock and the cost basis is $1.50. And it might be in a trust, so there's no step up in cost basis. There's more nuanced tax benefit in the US, but for whatever reason, the cost basis is $1.50 and the stock is at $120 or at $80, right? So there will be a huge tax consequence if you sell it. So there are times when I have to work around some legacy positions. And in some cases, my positions have become legacy positions because we've held it for so long and there's such a big gain. Then exiting it and redeploying it comes with consequences. Unless there's a huge, huge reason to sell it, I take my time and choose not to. So there are all kinds of different considerations that I can take into account, given that these are separately managed accounts instead of a fund that has to have exactly the same for everybody, no matter what their situation is. So a lot of layers to it. I do look at the benchmarks because I'm curious, but you and I know that benchmarks are man-made. And there's no page in the Bible that says that we need indexes and benchmarks. Let's remember that. And then they evolve and change, and they're actually managed in some way. As you know, stocks are added and removed from the benchmark. And then how they're structured, the Dow is structured in a different way than the S&P 500. And then the peculiar thing happens that if you take the same index and you do an equal weighted version or a market cap weighted version, you have very different returns. So when you say, well, the S&P is up this and that much, I need to know a little bit more. And actually at the time we're talking, which is mid 2024, there's a massive concentration in a lot of those benchmarks among very few stocks that are $1 trillion, close to that, companies that represent much more of the benchmark than they would usually do historically. So if you don't have the handful of companies, you might be on the wrong side of history for the time being, or if you don't have enough of them as well, right? You might have not enough of them. And I think those things have a way of evening, they even themselves out over time. So I would be very cautious. If you pull out a data point, look, I outperformed the benchmark in 2002, and I outperformed the benchmark in 2022. You have to tell me so much more about it for me to really understand what happened, what the context was, and even how you got there, right? If you have a portfolio of 4 stocks, it's a very different conversation. At the end of the day, I think the big picture, can you replicate what you've been doing so far? Is the investment approach something that you can replicate? And buying quality businesses, I call myself a value buyer, growth holder. I want to buy quality at a discount. I lean towards things that got sold off, that got cheaper. When you look at any stock, and it could be a whole episode on itself, on its own, but when you look at any stock, just as an exercise, the last 52 weeks or last 5 years, you have a wide range. So even the companies that you really want to own, you'll notice that they were available in a range somewhere, I don't know, between $10 and $50 or between $50 and $150. I know what I want to own. I have a long list of very attractive businesses I'd like to own at some point in time, but I'm very, very patient given the clients that I have and investment style that I have, that I can go in and buy something that sells off, 30, 40, 50%. And if you wait long enough, it happens again and again and again. And also among the high-flying stocks of today, if you're honest with yourself, in the last 10 years, a lot of them had 30, 50% drawdown. So if you just wait, even the ones that you think got away, you might have a shot.
I like the fact that you have this broad range. You say, for instance, the ambition is to generate 5 to 15% returns. And I love the fact that it's so wide, right? It's not exact. And I think,
No.
I wish there was more of that, because most managers will have a very sort of specific number, perhaps both for returns and volatility, which and that's a very different game. I get the impression you subscribe to this idea of not optimizing, right? But sort of satisficing, I think, is what Tom Gaynor talks about or refers to. And I often say to students, look, you can look at all these incredible track records from people like Lynch or Druckenmiller, but of course you need to consider that, you got to find your own sort of playing style. I'd like to think of it as similar to sports, right? If you play football or ice hockey or golf or tennis, you will develop your playing style, and it should be the same way in investing. But somehow I think many of us tend to forget that. It seems like there's this idea that there's a right way of doing things, right? And so, is it right to say that, that idea of not optimizing is something that is quite central to what you do?
I think I'm much more relaxed about not being precise about things. So I don't have price targets on the stocks I buy, which I think is quite revolutionary, because I worked with a lot of people that were obsessed with price targets. And I think it creates a problem, because if you bought something right and it reached the $50 you had in mind, you sell it. So that's one thing. Second thing, having some precise expectations that this year will be a 15% year, it's not helpful, and it doesn't get me anywhere. I want to be directionally right. I want to buy the right businesses for the right reasons, in the right context, in the right framework, at the right price, directionally right. But I understand that things will change and evolve. The product launch gets delayed. Whatever they promise in terms of cost savings gets delayed. And the CEO chooses to step down. I have to look and see what else is changing, right? everything is always in motion. So when people say, buy and hold and forget, I don't think it's actually something I would practice. I'd love to hold on to something for a long time, and I've seen huge benefits of holding something for 10, 15 years. Chris Mayer talks about 100x stocks. It takes time for the stock to go up 100x aspiration, right? Like if they go up 20 times, 50 times, but it takes time. I like this idea of me trying to be the least wrong. I think a lot of people get into investing to be right. And I just had a call earlier this week with somebody who left the institutional side, and he said, like, in that space, they thought they have all the answers. And then now he's managing his own money and family money, and he says he realizes that he has this permission not to know. I don't know where the interest rates will go. But even though I don't know where the interest rates will go, what can I do and what kind of investments I can choose that no matter what happens, my results will be decent. I will be the least wrong, right? What if we have a global pandemic and we all have to stay home for 6 months and in some places for a year or two? What kind of businesses will still make sense, right? Yeah. And on and on and on. You kind of have to go scenario by scenario, what kind of things make sense. Now, if you choose an investment where all the 5 elements have to be perfect, you're asking for too much. That's my lesson, right? Like if you need this to go perfect and something else to go perfect and the consumer accept this and the pricing accept it as well, and you're asking for way too much. And maybe you have a regulator in your industry and you want the regulator to tweak things so they're in your favor, and you need the tax rate to stay at a certain level for this investment to work, and you have to have the interest rate to stay at 0 for it to work. You're asking for too much. So this is the place where I don't want to be. I want to be in a place that's kind of all-terrain scenario. When things don't go exactly the way I thought, are we going to be okay? I had somebody, Elizabeth Paget, that talked about the story of her climbing the Himalayas with a Sherpa. And the more she talked about the Sherpa as somebody that keeps an eye on you and takes you all the way to the top of the mountain, somebody that plays such a huge role in your adventure, but is almost, invisible. That's the role a really good advisor plays. They'll take you all the way to the top of the mountain. They'll worry about everything that they should worry about. They have all the experience of doing it again and again. But you have this comfort and confidence and courage that they'll bring you back down. And that's what family wealth investing is all about. We're those Sherpas going up the mountain. We kind of know the terrain, but we know that the weather and everything else can surprise us on the way. And we want to be ready for it. We don't want to be the guy that goes in, wearing shorts because it's a sunny day in the Himalayas. No, you want to have layers with you. You want to have a good tent with you. You want to have extra food with you. And that's how I think of a portfolio. What if things don't line up? Are we going to be still okay? And the better part is that if there's a hiccup like March of 2020, if you're well positioned and if you're ready for it, you can take a huge advantage of those times and reposition the whole portfolio and add to the stocks you already like, or add to stocks that were on your list, and really set up the portfolio for the next 3-5 years. I think you do it again and again and again, something that's repeatable. That's the essence.
I agree. I share that mindset, Bogumil. Last question, so let's end on a happy note here. How do you deal with underperformance? I ask this question because I find that a friend
wants to know.
Exactly. No, actually, I find for myself, but also when I look at a number of managers that invest in a way similar to mine, without labeling it too much, but people who invest in seemingly good businesses, like quality sort of minded investors. And I think especially if there's a growth element to these businesses, and who haven't been sort of exposed to the large US tech names and some other businesses. It's not only the 7, but
I
think you get the idea. They've had a difficult time. I've had a difficult time in terms of relative performance, and a number of sort of similar minded investors have as well. What's been, and so even if I have a very long-term vision and sort of mindset and long-term objectives, it's frustrating, and it does make you, and I think it should make you reassess, or at least rethink what you're doing, right? Have things changed permanently, or is this a temporary sort of issue or setback? So what's been your experience? How do you deal with it emotionally assuming you've had periods like that, Bogumil, but I think most of us have.
Oh, yeah, it's part of the experience. You have to have those times. I mean, there's no question that it happens. I think the hardest time for many people was that bull market that followed the early pandemic, 21 especially. I think 21 was the peak of it. And I have to tell you that people that I have a lot of respect for were trying to completely redo what they're doing. And I don't think that's the path. I think there's room to tweak the way you think about things. There's room to evolve as an investor, as Buffett did, and as I think both of us have in the last 20 years of doing this. I think we both evolved as well. But switching everything around because for 5 minutes something else works, I don't think that's the recipe. I think Peter Lynch actually had this one advice. I think he said that if he has one advice, it would be to never buy the hottest stock of the day. And I think there's a lot of wisdom. Like whatever is the hottest, just don't buy it, which is the hardest thing to do for a lot of people. But when you talk about underperformance, I think one thing is, am I still making money? Have we actually grown the wealth? Like that would be my first gauge. Like we actually bought something and it has done well and it's up. And second is try to look around, what are the benchmarks doing? And these days the benchmarks are actually all over the place, especially over some short periods of time. The Dow could be flat and the Nasdaq is down up 25. I mean, they're all over the place because of how they're built. So which benchmark you're looking at. But at the end of the day, I look at the businesses that I own and I'm looking at them and I'm thinking, are they better than when I bought them? Is there a reason to hold on to them? And I see so many cases. I think that the one thing that it's very tricky with investing, that it's not linear, that the business grew 25% and the stock price is up 25%. It doesn't happen that way. It takes time. So I look at businesses and in some cases, in periods like that, I would look and I would see this business is about 50% bigger and better than it was 3-5 years ago. You know, the sales are better, the profits are better, whatever it is. And the market, for whatever reason, is not appreciating it enough. I mean, the valuations explain some of it, right? And I'm looking at the actual fundamentals. And if I'm seeing that the businesses we own still make sense and they're doing the way I expected, I think I'm onto something. But back to your earlier point, I don't want to be limiting myself in the sense that I will not be open to change. And I met a lot of people that label themselves as value investors, and they say they would never own a tech company. And I think Buffett had that opinion for a long time, for example. And being open to the fact that the industries that we will be invested in today or 20 years from now will be different. So I just want to be open to it. But I remain very firm and deliberate with my filters in terms of the valuations and the quality of the business and so on. So the best thing I can tell you is that I do ignore the benchmarks a lot. And if you ask me, on most days, I have no idea how the benchmarks have performed year to date. I don't know. And on most days, if you ask me if the market was up or down today or this week, I honestly don't know. And that's not where I put my attention. And sometimes people ask me, like, how often should I look at the portfolio? I mean, I know what's in the portfolio. I know very well what's in the portfolio and how it's structured. And the reason I look at some stocks is because I want to buy more. And I have some alerts that tell me, look, this is down another 10%. And it kind of reminds me to go back and maybe buy more. So that's how I look at it. But I think we would do a huge favor to ourselves and our minds and our stomachs if we ignore the benchmarks completely. I know it's a huge ask because you take the elevator in New York, you get on the plane, there are those little screens running in so many places that tell you the S&P 500 is up this much and that much. People don't even know what the S&P 500 is. If you ask them, like, what's in it these days? I don't really know myself.
I think we just probably there as well.
Yeah, if we could just ignore it. But I think the best first test is, are these businesses doing better? Second one is, are we making money? Like, do we have more than we had? And the third one, if you want to torture yourself a little bit, look at the benchmarks and see why are they up? And try to understand. Now, if you show me a benchmark and you tell me, look, the actual earnings per share are up 25%, and the benchmark is up 25%, I call it a deserved gain. But if the earnings are up 5% and the benchmark is up 40%, we both know that it's got to correct. And there are two ways to correct. Either we have this miraculous catch up in earnings, or the valuations will come down and the 40% is not long lasting. I think you have to understand the context, and it's easier said than done. And I think having the right clients helps. And, be kind to yourself at the end of the day. Torturing yourself about those things, especially in the short term, I think can really distract you away from what it's all about and why you're doing it. And that would be my lesson. I mean, I honestly wish sometimes that benchmarks were never invented. And if they were, I'm trying to think what would be a perfect benchmark and what's the purpose. And it's a whole conversation on its own. But if your question is, would you rather put all your money in the S&P 500 ETF or manage it yourself? It's a different question, right? And here, a very quick, explanation that I would share is, I see investing as a lifetime of contributions or a lifetime of distributions. So if you're putting away $1,000 every month and you have no interest in stock picking and you have no one in your life that can help you with that, that's fine. But you can still have an account and put $1,000 or for a retirement account, automated, whichever way. And then the S&P 500 ETF makes sense, right? You don't have to think about market timing. You don't have to think about anything. You just slowly put money away and you're an owner of businesses, just like you and I, just all of them at the same time, and you kind of surrender in some way. At the other end of the spectrum, you have a lifetime of distributions. And a family comes to me and they say, we have $50 million. I can't possibly, if it was my money or if it's their money, I can't possibly put it all blindly in an ETF tomorrow and say, hey, S&P is here, we're putting it in. Everything that happens to the S&P happens to us. I can't do it. And I don't know a family, I haven't met yet, that has done it. I haven't. It's not done. So they will be collecting distributions out of that capital for years to come, living off of that capital. And the capital will grow and flourish. But the last thing I can do for them is say, let's put it in an S&P and hope for the best. No, I need to build a portfolio. I have to know what's in it. And then the whole experience splits between me keeping track of the S&P 500 and me keeping track of what is it that I'm trying to do for them.
I think you passed the test, Bogumil. I have no more questions. I'm done.
No, I loved it.
That's it.
I knew we were going to have fun, and you and I said, let's keep it to an hour, and we're coming up on 2. So
we didn't do so well on that, did we?
We didn't. It kind of reminds me of the Upstream Brewery in Omaha, and we just kept talking. But I'm glad we did it, and you have such thoughtful questions, and I really appreciate them all.
Thank you. I really enjoyed it. And
look, investing is such a fun pursuit because it touches on so many aspects of our life, and it's intellectually stimulating, and you meet people that are fascinating, and you get to read about things that you're curious about. And if you're right more than you're wrong, over the long run, you'll end up with a bigger snowball that you started with. I mean, when you think about it, sign me up. And
it's a pretty good game. I agree.
And I'm so grateful that I randomly picked up that book, One Up on Wall Street by Peter Lynch in my early 20s. And I mean, somebody asked me, but I wish I picked it up when I was 8. But I don't think I was ready for a book like this when I was 8. I think that's maybe Buffett was, but I wasn't. So I'm glad it crossed my path at the right time, and here we are talking about investing and what kind of investing, and I absolutely loved it. So thank you so much for indulging me.
Thanks for giving me the opportunity, and we shall continue the conversation in Zurich, I hope.